Accumulated earnings tax, all these wonderful taxes. Accumulated earnings, essentially just retained earnings. The accumulated earnings tax is a penalty imposed on regular C corporations to discourage them from retaining earnings, excessive earnings, instead of distributing them as dividends to shareholders, particularly those in high tax brackets. Here are the key points for this tax. Again, we want to get the cash, the capital out to the world, the big, beautiful world. We've got a lot of people that want that money, so we don't want corporations hogging it all. One, imposed on regular C corporations. This is applicable to regular C corporations with different accumulated earnings thresholds for different types of corporations. Regular C corps are allowed a lifetime accumulated earnings limit of $250,000, while personal service corporations have a lower limit of $150,000. This is not imposed on certain entity types such as personal holding companies, tax exempt corporations, or PFICs. The IRS assessed tax is assessed during an audit, not self-assessed by the corporation. The tax here is levied actually when the IRS concludes that insufficient dividends were paid out relative to the accumulated earnings of the corporation. So it's not a self-assessed rule. This is the IRS comes in and says, this is what you got to do. The tax rate here is a flat 20% for our accumulated earnings tax, avoiding unreasonable accumulation. To prevent the accumulation of earnings being considered unreasonable by the IRS, the corporation must demonstrate either a specific, definite, and feasible plan for the use of accumulated earnings. Meaning, if you are holding on to all this money and your plan is to use that money to buy a bunch of machinery to expand the business, okay, that's a legitimate reason. The reason you're not distributing the money to shareholders is because you're going to use it for a real legitimate business purpose, and you're not just holding on to it to be a dragon on your pile of gold. A need to redeem corporate stock included in a deceased stockholder's gross estate. This, again, if there's just a real legitimate reason, I know that one seems random compared to point A, but if there's a legitimate reason for this, then yes, that's totally fine. Now, this is likely much more for a smaller corporation, not something you see on the New York Stock Exchange. Widely held stock not exempt. The fact that a corporation stock is widely held does not exempt it from this tax. And we'll talk about dividends and consent dividends. What's the difference there? We have a slide on that as well. A dividend paid by the due date of the tax return or a hypothetical consent dividend may reduce or eliminate the tax because, that's the whole point. If we pay out taxes, we pay out dividends from our retained earnings, we're not going to have this tax. That's the whole point, is to get the money out and flowing. The IRS wants you to pay dividends so that they can collect that sweet tax on that dividend income. All right, what are these? If you've never heard of it, no worries, we'll go through it. Actual and consent dividends. So actual dividends, pretty much what you think of when you think of dividends. These are traditional dividends a corporation pays out to its shareholders from its post-tax profits. These dividends are typically distributed as cash, additional shares of stock, or other property. Lots of questions you'll see on this dividends. You get land as a dividend, you get additional stock. This is your iconic, where you see this in the financial exam, on this exam. Again, just your classic dividend. For example, if a company declares a $1 dividend per share, a shareholder with 1,000 shares would receive $1,000. Pretty straightforward, nothing wild there. While wherever consent dividends, these are a less common form of dividends, and they're unique to U.S. tax law. A consent dividend is a dividend that a corporation declares, but it doesn't actually distribute to the shareholders. Instead, the shareholders consent to have the value of the dividends added to their own taxable income as if the dividends had been received. This increases the shareholders' individual tax liability, but it also reduces the corporation's earnings and profits for the purposes of the AET without requiring any actual cash outflow from the corporation. Now, we'll talk about why, okay, maybe that makes sense, but why would you do that? So again, the only difference between these two is that the cash is not actually given to the shareholders. The shareholders are taxed on the dividends. It affects the AET, right? We're dealing with all that. Awesome, cool. But what's the point here? Well, in both cases, these dividends help reduce the corporation's accumulated earnings, potentially helping to avoid triggering the AET. However, actual dividends involve the actual outflow of cash or property from the corporation, while consent dividends only involve an agreement to treat a certain amount of income as if it had been distributed. Consent dividends can therefore be a useful tool when corporations wish to reduce its accumulated earnings, but they lack the liquidity to pay out actual dividends. That's an important point. If they've got no cash on them at this point, because remember, retained earnings doesn't actually mean you have that cash in the bank. It could very much be quite different. You've got retained earnings of, let's say, $50 million, but maybe you've got no cash. Think debits and credits. You don't actually have to have the cash for the retained earnings. So if you've got no cash to actually give to your shareholders, if you get the consent here and the approval of everyone, you can do this and they'll pay tax on it, the shareholders, and it's as if you pay dividends, but it's like an IOU. They definitely owe the shareholders those sweet dollars. All right, we're going to see an example for the accumulated earnings tax here. Nova Corp is a software development company. It was organized on January 2nd, year two. Gotta love it. They always put the questions on January 2nd. Celebrate New Year's. Take the first day of the year off. That actually is a trend I see throughout in various review courses and on the exam. It always starts January 2nd. It's a holiday. Let's not work on a holiday. Its year two federal taxable income was $500,000, and its federal income tax was $120,000. What is the maximum amount of accumulated taxable income that may be subject to the accumulated earnings tax for year two if Nova takes only the minimum accumulated earnings credit? Now, for the accumulated earnings tax, in this case, accumulated taxable income would be equal to the $500,000 minus the federal income taxes of $120,000 minus the minimum accumulated earnings credit of $250,000 for software development companies, or $130,000 here. There we go. That's another example of what we see here. This minimum accumulated earnings credit, that is $250,000. I would definitely take a look at that, make sure you're familiar with that number. I mean, if this were to be heavily tested, this is also not historically heavily tested. But again, I'd rather just show you certain credits, show you how they work through examples rather than just preaching examples. I love examples, I do. And I'm talking too much to you as without going. Let's move on and see the next slide. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.